Okay, good afternoon, everyone. Thanks for joining our webinar. We're going to be discussing retirement income and whether it's a mix and match approach. We've just been waiting for everyone to get started. We did start a couple of minutes late, so we will get going now. But I'm delighted to welcome you today. We've got an expert panel joining us to discuss this topic. My name's Jane Brown. I'm one of the lead consultants of Simplified Consulting. And as mentioned, we're going to be discussing retirement income, the rise of the annuity, and whether there's a bit of a need now to create a more personalised income solution, looking at like the guaranteed and the flexible income and some of the challenges as well that are being faced in the market today. There will be a live Q&A at the end of this session, so we'll make sure that we've allowed enough time for you to ask your own questions. So if you would like to ask a question as we go through, then please just use the Zoom functionality and we'll make sure that we ask some questions at the end of the panel. But before we get started into the discussion, just like to invite the panel to please give a brief introduction to themselves. So could we start with you, please, Cecilia?
Good afternoon, everyone. Hello, Jane. Thanks for having me. Firstly, it's really nice to be here to discuss this topic. I'm Cecilia Ferner, and I'm Distribution Director for Legal & General's Retail Annuities business.
Thank you. Thanks very much. Rennie?
Yeah, thanks, Jane. Good afternoon, everyone. I'm Rennie Biggins. I'm Head of Retirement for the Investing and Saving Alliance.
Thank you. Andrew?
Good afternoon all, I'm Andrew Tolley, I'm Technical Director at Canada Life.
Thanks, Andrew. And David?
Good afternoon all, I'm David Simpson. I head up GBST's EMEA region.
Great, so great to have you all here today. Really appreciate all of your time for this discussion. So let's get started. So in 2022, there was a survey that was conducted by the LANCAP, which identified that only 47% of advisors would be willing to consider offering their clients an annuity solution. So first off, I just wanted to ask really what has got to change to bring that traditional and hybrid annuity back onto the advisor agenda. Who'd like to kick us off?
I'm happy to. Yeah. Ladies first.
Thank you. Thanks, Rennie. I think I can open the discussion. I'm sure, Rennie and Andrew, you would want to add to this as well. But firstly, I think, a lot has changed over the last 18 months or so. We've certainly seen a lot of change in the market. We've seen volatility in the market is really kind of, created almost a perfect storm for clients, or for many clients, have suffered losses in the market as well. So we've seen the market volatility. We've also seen rates increase for annuities. So all of this has really changed the perception of annuities for financial advisors. But I won't say that advisors haven't been considering them. I think they will always be part of the decumulation consideration. But I think all of these kind of factors within the market certainly put things in context. And if you look around, you look at other assets, and you look what the kind of returns are that for specifically for a more cautious client that you can find out there at the moment. I think annuities have certainly come into their own and should and can form part of a holistic approach to decumulation. I don't know, Andrew or Rennie, what do you want to add to that?
Thanks very much for that, Cecilia. Yeah. So yeah, just looking at what happened sort of in the last year with annuities. So, taking some of the FCA stats and some other stats that are out there, sales rose 13% in 2021-22. And quite interestingly, over a quarter of the annuities that were sold were for a pot size of £10,000 or under. So maybe it was people just chunking up their income and partially transferring across into an annuity. So perhaps that represented a lot of those sales. And actually 73% of those sales that were pots under 10K were linked to MAPS guidance, with only 6.5% of those being advised And overall, out of all annuities for all pot sizes that were purchased, 41% of individuals had MAPS guidance and 18% regulated advice. So, you know, that maybe that sort of low, surprising figure of 47% sort of backed up to an extent by some of those figures there. But I'm still sort of surprised. It is surprising why 53% of advisors wouldn't even entertain the idea of an annuity, especially when you consider most people are going to need a mixture of flexibility and guarantees with their income, you know, in some ratio, differing ratios and at different times during their retirement. But overall, you know, that mix of flexibility and guarantees is going to be pretty appropriate for nearly everybody. So, you know, annuities should always be considered, even if it's only to rule them out as not appropriate at that particular time. I guess we've had the cost of living crisis as well. We're still firmly entrenched in that at the moment, but you know, it'd be interesting to see what sort of impact that's had on household income, and maybe that prompts the consideration of sort of guarantees as well. So perhaps we'll see that figure rise from 47% in the coming months. And also at the moment, of course, you know, thinking about DB, a lot of the retirees still have an element of DB at the moment when they come to retire. As we move into Generation DC, you know, then, you know, those guarantees are not going to exist. And so perhaps that might also sort of prompt the consideration of annuities further as well.
How about from your perspective, Andrew? Did you have?
Yeah, I think just to echo what the guys have said, the increase in rates will undoubtedly shift the market. So you know, the rate of income on an annuity is always going to drive it to some degree, the purchase. So, you know, we've seen probably a 40% increase over the last year. So that's a massive, you know, seismic change in the figures. If we put that in monetary amounts for 100,000 for a 65-year-old, beginning of last year would be about £4,500 a year. Now it's probably about 6,400 a year. So if you extrapolate that over a 30-year retirement, that's a, you know, massive increase in the amount of income that a client can get. And we've undoubtedly seen a big increase, you know. So at Canada Life, I think we saw about 55% increase in quotes in the second half of last year in annuities. So there's definitely more interest. That's not necessarily led to a 5% increase in business. So it's definitely being looked at, but by advisors. There's also probably a need for, many advisors probably haven't looked at annuities for 8 or 10 years. So there's probably that back to basics approach needed. So we've certainly had lots of requests for training and, you know, reminders of death benefits and reminders of the process around making sure that people take health and lifestyle into account and make sure they shop around and get the best rates. So there's definitely been a huge step change in the market, and people will consider annuities. But as you know, as Remy says, it's not in all situations. Sometimes that's just to rule it out. So we need to bear in mind, just an increase in rates doesn't make annuities best for everyone. It will be a good solution for some people, but that doesn't necessarily also need to be at 65. So annuities at, you know, 70, 75, maybe even 80 could be a valid part as people move through that retirement journey.
Absolutely. I think if I could just add to that, Andrew, you've raised an important point around the rates, and if our audience want to look at it in a different way, so you quoted the increase in income that customers or clients can expect through financial advice. If you want to look at it a different way, the pot size required to purchase the same amount of income has seen about a 35% decrease over the last 2 years. So you need, on average, about 35% less fund to purchase the same amount of income you would have done 24 months or so ago. So again, that really puts it into context. And then, Andrew, that really leads very nicely to the point that you've made there around, you know, how you use it throughout the accumulation, so throughout retirement, and not just at crystallization. So you have to look at it and how it can be layered potentially in as you age specifically as well. And just one other point you said there that really kind of rings true for me, Andrew, is the kind of back to basics as well. We've had, and I was on a different webinar a while ago where we've actually had a lot of requests to say that. So a lot of your more experienced financial advisors will will know annuities back to front and understand how they work. But my challenge to those people will be, have you looked at them recently? Because there's a lot that's changed in the way that the products are used. You know, you now get fixed term annuities, lifetime annuities, and how you could possibly use those, and death benefits. But then also for the kind of new generation of financial advisors who have come into the market, they just weren't, you know, many of them might have started and joined the profession post pensions freedom. So that kind of basic training around lifetime annuities and guaranteed income, you know, just wasn't part of how they were brought into the profession. So I think, yeah, there's a lot that we can do as well as providers to remind financial advisors of how guaranteed annuities, or guaranteed income rather, can be used.
Great, thanks. You often forget the advisor perspective. We always talk about the customers needing more guidance through retirement and so on, but you know, it's really interesting to hear that from the advisor's perspective. Dave, did you have a perspective to add here in terms of your view?
Yeah, absolutely. Thank you. I think coming from an operational technology background, I think from my perspective, there's still a lot of operational friction in the process today, which really doesn't help. And there isn't many easy or seamless ways in which you can transition your accumulation pot into a deaccumulation pot through an effective, simplified kind of experience or solution. And I think that doesn't help. I think the way we operate today, generally in our lives, we all looking for automated administration or automated services and solutions and access to information. And considering that a lot of the technology that backs or underpins these types of products has lacked innovation and investment for some years, that can lead us back to a lot of manual, offline, paper-based processes and quotations that break journeys from an advisor or from a client's perspective that actually doesn't help seamlessly completing the kind of decision process. I am happy to say that, you know, some investment is being made, and I do see from our perspective that this is starting to change, and the ease at which an advisor should be able to bring together a guarantee or fixed income solution with an element of flexi access drawdown under a single solution, actually on a platform as well, where a lot of the business is being transacted today, and adjust these in a way that suits the personal circumstances for the consumer. I think that's changing and that's evolving. And once that becomes more efficient, I think we'll see annuities coming back strong on the agenda for advisors.
Great, thank you. So on some of those sort of products that you've just spoken about there, some of the solutions that are sort of coming through, you know, the more traditional annuities, alongside some of the other products, this was sort of seen as quite innovational before. But are we saying that these are now like a must-have solution for providers to have, like based on what you were saying, Dave?
I don't think there's any must-have as far as providers are concerned. So I think probably an important point from an advisor. If we think about things like Consumer Duty, also FCA retirement income review that's going on at the moment, is there's going to be greater scrutiny on this market from the regulator. So from that point of view, it's important advisors are aware of all the products in the market, or aware of all the different options in the market. And then they're considering what's appropriate for each individual client. So it always comes back to client needs. What does the client need? The fact that you can now hold an annuity inside a SIP wrapper is a benefit for some clients, but not for a client who just doesn't need guaranteed income at all. So that overlay of client needs always has to be first. And then making sure the advisor is aware of all the different solutions that could be an option to deliver what the client needs.
I agree with you there, Andrew. This time you can go, Rennie, please.
No, thank you, Cecilia. No, I totally agree. It can't be a must-have. It depends on what your target market is. You know, when you think about the challenges that consumers are facing when they approach decumulation, and what their needs are, obviously engagement is a massive thing there that biggest nut we need to crack. But you know, in terms of what the needs are in retirement, then as I've mentioned already, you know, it's going to be for most people some sort of combination of flexibilities and guarantees at different stages throughout retirement. And what products do we have out there that meets those needs at the moment? Well, we do have annuities, temporary and lifetime, and we do have flexi access drawdown as well. So those two products do meet two very important needs. Problem is, of course, as I mentioned, the whole aspect around the lack of engagement. And I think what we do in the industry, we put a lot of sort of emphasis on the run up to retirement, and we have all the wake up packs and the various nudges and communications that go out to sort of say, have you thought about how you're going to take your pension? But once you've actually started to access, then largely there isn't any real support for people as they go through retirement. And considering most people actually go into drawdown, then they're going to need ongoing support, and they're going to need to be reviewing that all right the way through their retirements. And I think the whole aspect around support there is something that we need to work on more for a decumulation framework. So in that respect, some sort of hybrid solutions, I guess for some people would certainly be appropriate and could take some of the will make it a lot easier to sort of manage your income through retirement. But certainly not a must-have. But like I say, I think we need to do more generally in supporting people as they go through the decumulation journey anyway.
Yeah, I agree with that, Rennie. And I think if I look at, I don't know how many of our audience would have seen the Institute of Fiscal Studies' latest report. That report is called How Does Spending Change Through Retirement? And it actually calls for more consideration to the funding of that essential expenditure for clients throughout retirement as well. So it's almost going back to that concept of a minimum income requirement, if you want, individualized, and what does a client need throughout retirement. But Andrew, I agree with both of you around the fact that there's no must-have in terms of, and that it needs to be bespoke for clients, that it needs to work. I think, the Consumer Duty requires that very good understanding of clients, of customers, of what it is that they get, that there's good and fair value within those products as well. So those are all really, really important points. But absolutely, can Flexi Access drawdown, and should it sit comfortably alongside a guaranteed income? At Legal & General, we often talk about layering that in. It's the 4L concept that we talk about, and many of our audience might have heard me talk about this, so I won't go through it all again. But it's the concept that, from a client's retirement income spending needs, you certainly have that base layer, and how do you make sure that underpin is in place for a client's portfolio. And it could be, Rennie, to the point you made, that a client only needs a lifetime annuity at the right time because it works for them, or it could be that throughout potentially 3 or 4 decades of retirement, that gets layered in, whatever the product or the solution looks like. But the concept is that guaranteed income is layered into that portfolio to give better outcomes.
I think if I may, I think a couple of points people touched on there. The personalisation point for me is key. We need to have solutions that will live with us as we live into our retirement years and can be adapted. And I think the hybrid solutions that have come to market at the moment, I think, are quite good at that. They're not necessarily the answer for everyone, but they're quite good at mixing up the guarantee. And I think those solutions will evolve further to the point where whether or not they are advised or provided on a direct basis or through some sort of guidance, that is quite a good solution for a large part of the population. Not for everyone, and like you said, not everyone needs guarantees. But I do feel that we do need a more simpler set of retirement products that are easily understood, and that could be down to education and communication. And I think they also need to address those that might have vulnerability characteristics. And I think Andrew, you touched on Consumer Duty. So you win a prize for mentioning it the first time. I think you mentioned it first, but I'll mention it again. So I think the Consumer Duty outcomes may also point to vulnerability in later life, and actually that could see us think about bringing consumers back to some level of guarantee as a solid backbone, like a minimum decision point. To support their retirement income planning, especially for later life care. So I could see where that might be like an underpin that you just need that in place, a bit like an insurance product. So there could be space for that from an innovation perspective. But I think at the end of the day, you know, it just comes back. You've got to have that way to mix the guarantee with the investment portfolio that allows you to maximize tax benefits over time, which no doubt will also evolve. But I don't think there is one silver bullet that gives you the perfect solution for everybody.
I think that's a good
Absolutely.
point, David, about drawdown in later life, because I think it's easy, you know, drawdown's been around for 30 years or more. It's easy to forget the concept of people going into beyond 75, beyond 80, still on drawdown is relatively new. That's a relatively new concept. You know, if we go back 10 years, people might have gone 75, but go again phasing out to buy an annuity. This concept of having investment risk in your 80s, and as you say, potential vulnerability, cognitive decline at that age. The idea of gradually de-risking a portfolio into annuities at that point, I think certainly will make sense for people. Certainly goes with smaller pots in particular.
Yeah, it's a good point, Andrew. And I think we're about to learn those lessons, right? So as you said, we've just post pensions freedom, where we were all told that nobody ever needs to go an annuity again. And you know, we've been through some market lessons over the last, you know, 5, 6, 7, 8 years. And I think a lot of those clients, to your point, how many will have an appetite? Because it's not just the concept of getting market volatility or across to a client, it's that volatility of their income. And I think that's a very different concept that advisors or clients, customers will need to understand. So it's one thing to see, you know, again, somebody mentioned accumulation stage, one thing to see a pot, and many would have again experienced it this week with what the markets are doing, you know, drop and go up and down. But it's when your income does that, it's a very, very different story for a client in retirement.
So what about the technology then? Do we need to see the sort of traditional annuity market kind of upping its game in terms of like the digital technology, having sort of equivalent online user journeys and new business journeys to be able to fully re-establish annuities as a contemporary retirement solution?
Traditional annuities probably haven't needed that because they're really a kind of one and done solution. People bought an annuity with the whole pension pot, and then they got an income coming into the bank account every month, and that never changed. And so there was no need for that kind of ongoing interaction with that product. If we're saying an annuity effectively just becomes an asset class of retirement, so people will have a pension pot, but then also their ISAs and other wrappers around that. But even within the pension, the annuity is potentially just a small part of that. It becomes just an asset that needs to be managed alongside all with other assets. So if you can do that all in one place, that definitely makes sense. So the concept of being able to manage all those different wrappers and all those different assets in one place simply and easily absolutely does make sense. So trying to have that annuity or that guaranteed income within a framework that an advisor could control and maybe a client can see and manage. And the beauty of having an annuity inside a drawdown wrapper is you have that element of flexibility ongoing. So potentially you can turn income up and down, which you can't do with a traditional annuity. So I think moving forward, absolutely it makes sense. Historically, it's probably not been needed, but I think as the way annuities are used changes in future, then yes, we do need better technology.
If you think about how open banking has revolutionized banking and how people engage with their finances as well, you know, it's had a huge part to play. Everybody's got a banking app on their phone. We're not there with pensions yet. We're starting to get there. But I think in terms of raising awareness around the various decumulation options that are available and beyond before that as well in accumulation, in just trying to get engagement, so at least you get a pot that's a decent size before you get to the accumulation, then technology has a really big part to play in that. Pension dashboards, of course, one example, which have great potential when they finally do get launched to the public. But I guess with technology, the other aspect we do have to make sure is we've talked a little bit about vulnerabilities here. and it isn't the only way to sort of access support and products. And there is always going to be a group due to certain vulnerabilities who won't be able to access through technology or use it to its full potential. So we do need to sort of ensure that there are alternatives passed along there, but you would expect a digital journey to be by far and away the most popular method for people communicating and engaging with their finances across all different types of finance. Pensions I see as being no different.
If I could, apologise first of all for the horrendous access problems I was having earlier. So, and also if I missed anything, but I think that definitely technology will make a huge difference for people managing their income in retirement. What I would like to see though is that it's not necessarily coupled in with the product wrapper. I think it's not beyond the bounds of possibility that people going forwards will start to be able to manage their own cash flow. And they could be looking at, okay, this is how much guaranteed income I need. This is how much ongoing, flexible income I need. And I'd like to see that being available without it necessarily being tied into, you need this product wrapper or that product wrapper. But of course, that then requires somebody who's got the resources to build it. The other thing is right at the other end of the scale, technology-wise, for annuity providers. If I could just say from the advisor's point of view, it would be so great if we could set them up nice and simply and easily and get quotes nice and simply and easily. And, there are some great providers out there, but whenever we are trying to get particularly underwritten rates, we're at a place now where we can't, we're waiting for rates for some companies when the others are about to run out. And that makes it impossible for us to actually, we have to make some impossible choices between, do we wait for something that could be better and risk losing something else that isn't? And I just think that shouldn't be beyond the wit of a provider to be able to do that.
I think there are a couple of points there, Fiona, that you picked on, if I may. I think back to the D2C solutions, I think that guidance or automated advice works really well for simple products. And to some extent, you can see a lot more online opportunity for guaranteed income solutions because they can fall into that. A lot of people can understand that. I agree with you. It's not beyond the belief that people can also start to manage drawdown effectively as long as they have the right education and tooling. Although I would say that's probably a little bit risky at the moment. We did some research a few years back, and I think 2/5 of people that have gone into drawdown have never had any investment experience in their life before, and they do so without advice. And that is a worry. That is a worry in reality, but it doesn't mean it can't be overcome. I think that the real barrier, picking up on a point Andrew mentioned earlier, that a lot of the annuity providers haven't really needed to invest heavily in technology or innovate. It's kind of been, here's an annuity, that's the solution. We are done. I think where we are now, as this market continues to effectively grow, we're seeing the need for new technology, new innovation, as you said, Fiona, the ability to hold an annuity basically as an asset class that sits within wrappers on platform as a seamless solution. We're seeing those demands, and a lot of the legacy technology just haven't been built for that. And it can't adapt. I mean, you can put new digital journeys on top of old policy administration systems, but really you're just papering over the cracks. I think what you really need to do, you need to think about a full digital environment where most of our industry has been going for some years now, and it's time for annuities to join that journey that has multiple channel points and can work effectively on a straight through process and get quotations real time. Why not? We do it for other products and lines. Annuities doesn't need to be special. So I think there's a lot of restrictions holding back innovation in this space at the moment. And as you said, someone's got to spend the money. It will be expensive to bring it to market, but collectively the industry is going to have to invest to be able to deliver the right products in this space. And I think that because we have to, whether everyone likes it or not, and I'm sure we are backers, but we have to think about how we facilitate good consumer outcomes. And the only way to do that effectively across the retirement space is for us to see that led a lot more by technology in the way we help consumers make decisions, but also advisors, picking up on the point I think Celia raised earlier. or Renee, we have to help the advisors be able to provide these solutions as well. So I think a lot is changing, but there's quite a way to go. Yes, I think technology does have a big role to play.
Yeah, so sorry, carry on.
No, sorry, Jane. I was just going to say, I agree with everything that's been said, or much that's been said in terms of, and I think the positive to take from all of that is what we've seen in the market over the last year or so, in terms of the volumes that are coming through, the interest, the way that direct customers as well as advisors use guaranteed income. So it's a very positive place to be at the moment for us all as providers, to be looking at how it's offered and what's being done, and we certainly want to stay close to that at Legal & General to make sure that we do offer fair value. And Fiona, to your point, we make it as easy as possible for financial advisors to use our guaranteed solutions as well.
If I could just pick up on something David said there that I think I probably didn't make clear myself, and I don't think for a second that people should be managing their own drawdown pots if they don't have investment experience and if that's the only lot of income they've got. But I think that there are opportunities where people have other sources of guaranteed income and maybe don't need all of it. And actually, one of the things about we talk about drawdown being such a risky product, and it is if you are relying on the income. But if you're not, then it's just the personal pension pretty much that they had before they went into accumulation. So for some people, it isn't, it's not an income pot, and therefore it becomes easier to mix and match.
Goes back to that individual, and the bespoke solution for each client, doesn't it, Fiona?
It does.
Yeah.
And one of the things we're seeing a lot of now is, again, it was touched on, smaller people who've been in drawdown for some time and whose pots are now becoming much smaller and economically becomes more difficult to justify the ongoing costs of drawdown. I'm talking both about product costs and advice costs of drawdown, because in the case of both the provider and the advisor, everybody's doing more work when it's drawdown, so that's why it costs more. But you get to a point where actually the pot perhaps isn't. It's more economically sensible to say, right, that's it. Let's cut. Let's just secure this now, and then in our case, the client then goes off and they don't need us anymore. They're not paying for us. They just get the income that they need.
It's also a higher risk for a client in that kind of situation. Fiona, if that's a sole pot and it's getting smaller and smaller, again, then the risk to that individual is increasing. So de-risking that into an annuity, or at least partly into an annuity, can make sense.
Yeah. And you've seen that in other countries. I think Australia and US have had a number of big court cases where too much freedom without control led to people running out of money too soon. So I think there's a lot that we all will learn and have learned from those environments, and I think we can bring that to bear with effective solutions in this marketplace.
Absolutely. And David, I think if we can add, everybody on this panel will certainly know the statistic, but the FCA's latest retirement income report quoted that over 40% of people take 8% or more from their drawdown pots, which is quite staggering. And I think the point is, when you look at constant spending from a volatile portfolio, it's going to amplify that sequencing risk, and people will run into trouble. So, yeah.
And we may.
Sorry.
Go on, Fiona.
I was going to say a little caveat on that one is that what you don't know from the FCA figures is how many pots people have. I remember, and it's years back now, but when I was working for a provider and we looked at the provider's own figures, the average withdrawal rate was much, much lower. And I suspect that reflects, first of all, there's an advisor involved, but also secondly, it could well be that people are using one pot. I mean, certainly there's a lot of our clients have got maybe more, 2 or 3 pots, so they've got a DB there. It makes sense to run down the drawdown pot in the early years when they know they've got, say, state pension kicking in later. So just a small caveat.
Yeah, that's a fair point, Fiona. And I think also we have to remember people's lives aren't siloed. They have other assets. So yeah, absolutely agree with you.
I think that's where Pensions Dashboard hopefully will play a good role to bring together that single view. I know that and that in its own right could actually create future fiscal policy changes down the line, where back to the 8% point, that a decision is made that some of that early access needs to be limited. If you look to the New Zealand market, they have something called a Kiwi Saver, sort of like our auto enrollment. And I think they also have an equivalent of Pensions Dashboard consolidated view. And I think that they put limitations of 5% on the access to make sure people didn't run out of money as they live their lifestyle. So I'm not suggesting I'm necessarily going to be a fan of those restrictions, but we could see changes to policy that actually try to control that more as people live longer going into retirement.
And as we've seen sort of the trends in pensions landscape change in sort of the last few decades, with DB in the private sector going, and auto enrollment now sort of firmly in place. And if you look at the ONS stats, people have got less pension wealth as they're getting older than their predecessors. So we are sort of storing up a bit of a pensions crisis in the future at the moment, because there are going to be future generation DC retirees. A lot more of those are going to have retirement pots that aren't going to provide anything like the sort of pension income and sustainability that it would have done for their grandparents and parents and things. So I guess that the whole aspect around being able to manage income effectively, and where technology has a part to play, is going to become ever more important for this growing group of people who just simply aren't going to have the assets in retirement that they probably need, and that their fathers and grandparents and things had.
Yeah,
I think that goes back to a blending point, Rami, is that people have effectively been doing blending over the last 10 years, but we've been doing it by the DBs providing the guaranteed income, and the DC pot's been the flexible bit on top. As we go into the next 10, 15 years, people aren't going to have that DB income, or if it is, it's going to be very, very small. So it's a gap potential is maybe why you need a bit of guaranteed income there to give them that security, and then have the DC pot on top of that. So I think it's something that's been happening, but it's just been happening in a slightly different way than we're maybe looking at over the next 10 years.
Absolutely. And I think, Andrew, lessons again, if you think, of course, for clients who seek financial advice, using financial advisors, we'll get that piece. But again, going back to the direct consumer, how many of them at the moment take into account, or how many of them are going to learn through hard lessons, the kind of the adjustments that need to be made for current inflationary environment, and so on. So all of that, is how do we adapt? And I guess, Fiona, also from a financial advisor's point of view, how many of them adapt their kind of analysis and the projections to kind of take into account the very different environment we find ourselves in now, and nobody knows for how long.
Well, I think the reality is at the moment that the vast majority of people who don't, anybody who doesn't have access to an advisor doesn't have any sort of projection or calculation at all. And Rennie, you're absolutely right. I mean, this is, there are lots of issues in pensions, but the biggest one by a long, long way is the issue of having enough money to provide the ongoing income. So it matters for the guys that we're advising now on drawdown, but it also matters very, very much for the guys who are in the future going to be looking at providing an income stream and have really no idea at the moment how much they need to put aside to do that. And if advisors are doing one thing, to be able to get that particular message over and give people a realistic idea of what they need to save up for, and then what to do when they've got it, then that's basically why we're here.
Absolutely.
And so then, just to close the final question on the main discussion anyway, before we go on to a Q&A. Obviously, there's a lot of friction at the retirement stage. So at retirement or later life retirement sort of decisions. So do providers need to have this single system to support the accumulation, decumulation, the traditional annuities, the hybrid annuities, all wrapped up in one proposition? Do we think that's what needs to be the way forwards?
The ideal, if it is possible, no, I don't think we do want one system, because I don't think in any particular sphere in life you ever get anybody who's really good at everything. And I think it's good to be able to benefit from people that have specialist abilities in different areas. What we do need, though, is a set of systems that talk to each other, so that when you're going from one stage to another, as an advisor, what we'd like to be able to do is say, right, okay, we've got one system. These people are good at investment, we'll use them for that. These people are good at the cash flow, we'll use them for that. This group have got a fabulous MOT, midlife MOT analysis or tax analysis, something like that. I appreciate all the efforts that providers put in, but I don't expect any provider or any technology provider to be the best at everything. So the ideal would be not one system, but systems that like each other.
I agree. I think, mentioned earlier, with annuities being often an off-platform solution, breaking the process creates inefficiencies, and there's always a risk. I could get some bad review on this, but there is a risk that that does narrow sometimes the outcomes that are being provided. So I think that there needs to be a better way to have a single ecosystem of technologies or technology underpinning it to be able to operate as though you're providing solutions from a single wider system, bringing all those pieces together. And that won't just benefit the customer, because it helps them keep track of, say, the different providers, everything they have in one place, a simplified experience, so it's easy for them to interact if that's part of the process. But it'll also help all the providers out there as well in their cost of ownership, because these manual processes are cumbersome. They can lead to create risk, lead to error, and actually being in that environment with real-time information, we know will reduce the cost of ownership for everyone in that space. And finally, the advisors. I mean, not to be forgotten in this, there's a lot of work that can go into trying to get the information, to do the preparation, the admin, the analysis tools, and the modeling, to bring all that together in a single ecosystem. And as Fiona said, it doesn't have to be one technology solution, but a single ecosystem actually has got to be good for everybody. So I think from my side, there's definitely work to be done here. I do feel that technology is evolving significantly in our space, but people need to embrace, and collectively as an industry, we will need to invest to make these guaranteed solutions and these at-retirement solutions really, common practice in the way that they're made available to consumers, but also used by advisors.
And I'll just sort of mention, when you sort of say about a seamless retirement, Jane, in the question, I guess, wouldn't that be great in a way? But it's a way, it has to have a proactive decision made, doesn't it? An individual has to make a decision, whether or not that's an advised decision or some MAPS guidance or a bloke down the pub, whatever. But there has to be an element of proactivity there, in some form. Which just sort of leads me on really to thinking about, that, and what we have heard in recent months, and I've spoken to a number of people in the industry, and there's a few supporters of sort of putting in place a default decumulation journey. So obviously for auto enrollment, you've got a default fund, you go into the default, you've got a default contribution rate, and people are saying, well, why can't we have that in decumulation as well? But quite simply, it's such a personalised journey with so many different variables. It just makes having a default extremely challenging and potentially detrimental to the individual as well. And I've spoken to several sort of big pension providers who have been looking into, is it possible to do this? But they're just coming up with so many challenges, and a typical sort of challenge really is, and we hear about sort of having someone defaulted into an annuity at a certain age. So say at 60 they elect for, well, at 70 I just want to be defaulted into an annuity. Don't want to have to make any more decisions at all about retirement. I want it all looked after for me. Thing is, a lot can change in that period between 60 and 70. You don't know what sort of health conditions they're going to maybe pick up in that time, and so you still have to review that to make sure just prior to age 70 and taking that annuity out, whether or not it remains appropriate or not. So I thought it was just worthwhile when talking about a seamless journey and just bringing in the whole challenge around putting any sort of default decumulation journey in place. It's simply sort of fraught with danger. That's where we really have to get people more engaged. And we do talk about a midlife MOT. Perhaps there needs to be a mid-retirement MOT as well, because as people going through retirement, your priorities change. No one really thinks about later life care in retirement and how that's going to be funded until you get to the point where you realize that you need it. I make no apologies for talking about the need for more support.
Yeah, like an annual review or something like that.
Yeah.
Which is fine for advised clients, but I guess there is a point for people who don't get advisors to try and make sure they review it. I think the one point I would just make on the seamless retirement is it's important we don't just focus on pensions, because people have got all range of assets across a whole range of different wrappers. We know pensions are particularly efficient for inheritance tax purposes, so there can be very good reasons not to be using a pension for retirement income purposes, and instead taking money out of other wrappers such as ISAs and things like that. So it's obviously advisors know that, and advisors are fantastic at helping clients decide the right order to take money out of the different wrappers, because that's the most tax efficient way. But it's that kind of thing to try and help non-advised clients in that area is quite a complex beast. But that's what we need to think about, is not just the pension assets, but wider assets too.
Absolutely. And the only thing I'll add there, Andrew, and I agree with you, and I think I've said it earlier around that kind of holistic view where, again, for advised clients, they get the benefit of that. So their lives aren't siloed, there are other assets. But for the majority of clients, I think, and we all agree, it still goes back for that the pension pot will most likely be used for income, and it is really important to create an income that's going to sustain them. And I think if we've learned anything, and it goes back to the point that was made earlier around, I think it's a very exciting space to be part of at the moment. We've seen how retirement for our clients, Fiona, and for end customers have changed within the last 10, 15 years. It's a very, very different space. People live completely different lives. And I often say this, but I think of my own mum in her mid-70s who only retired last year from a career of 50 years in medicine, and she still doesn't see herself as retired. So people retire very differently, they have very different needs, and quite often get to retirement and still have, take care of elderly parents themselves. So talking about, all the different kind of responsibilities that they have, and then have to kind of navigate 3 or 4 decades of retirement income, and whether they do it themselves or they do it through financial advice. So it's certainly an exciting space to be part of, and let's see where this all heads in terms of making it as easy a possible journey around your points, Fiona, for financial advisors, but certainly for customers as well.
Great, thank you all for your views. That's really, really interesting discussion. We've got a few questions, so should we go over to some questions from the audience? So the first one is talking around, so this is from Karen Lauder. Thank you, Karen. Do you ever see providers getting together to coordinate expiry dates? You send all of the requests off to providers on the panel on the same day, and they're returned between 48 hours and 2 weeks later. So some illustrations are expiring as soon as you receive the last one.
What was the question, Jane? Sorry. Is it whether we see what?
Do you see all of the providers getting together to coordinate better? So I think they're talking about like the processes being sort of quite disjointed between one provider and another.
And I think, Fiona, you touch on that as well. Andrew, I don't know what your view is on this, but it's clearly an issue, isn't it, around guarantee periods. Not all providers have the same guarantee periods, and then some take longer than others to bring out a guaranteed quote that's fully underwritten. I mean, would that give? Yeah, Andrew, I don't know what your view is on that in terms of we could do it better, I guess.
It could definitely be done better, I guess. Annuity portals try to do that to some degree, and they probably manage that quite well on healthy rates, where the portals probably don't do so well as the underwritten rates, because you don't really take underwriting into account fully. So, but is there a way that providers could work better together? Again, yes, I'm sure there is a way. But we need technology to do that. So pushing lots of bits of paper around desks isn't the way to do that. So it needs to be a technology solution to drive that.
And I think we touched on it earlier. To me, I think the industry should sign up to an SLA in providing these, and they should come back at the same set of times, because as an advisor or an individual, it's difficult, as you say, some are expiring, some are still coming back. I mean, that just doesn't work for anybody. So I think there's a way to go, but that's easy to say and not easy to do. So I think we've got some way to go, but that should be an ambition.
Agree, yeah.
Another question is, how does the industry debunk the myth that annuities are bad?
That's a good question, isn't it? I think also I think it's the word, Jane, to start with. You know, quite often. So we've some L&G research has shown that last year over 900,000 additional people are kind of planning or saying that they're looking at annuities who wouldn't have done in the past, right? But also a lot of the research shows that when you ask people if they want an annuity, they say no. But then when you go through a set of questions, yes, they want guaranteed income that will never run out, that will, you know. So it's quite an interesting question, depending on whether you speak to the end customer or you speak to financial advisors. You know, why the word annuity has fallen out of favor. We know why. Post pensions freedom, it was seen as an alternative. You know, why wouldn't you want flexibility? But I think we have to all just come together, educate again, and say it's not a binary decision. Flexi access drawdown and annuities can sit together and possibly give better outcomes, and that should be the answer, and it will for many clients. As I said, give better outcomes. Sorry, Andrew, I think you were going to come in there as well.
No, I completely agree with what you've said there. So I think it was slightly ironic back in 2015. So one of the big issues with annuities was always the fact that death benefits were seen to be quite poor. So people died in the early years, and the family lost the money, and that was a big detriment. And so it was slightly ironic at the point in 2014, 2015, when effectively the whole market just moved completely to drawdown, was also the time that solved that issue, because now we can offer things like 30-year guarantees, and that means, you know, probably we're talking about an 18-19-year guarantee gets your money back, or gets the family of certainty. If they put £100,000 into the annuity, the family will get £100,000 back, even if the member dies. So if you put, say, a 30-year guarantee on, you're getting a significant return over and above that. And I don't think that message has ever really got out into the public domain. I don't think that's just because it was part of the pension freedom changes. I think the whole every newspaper just started talking about drawdown and the wonderful death benefits. So I don't think that kind of solution to one of the big annuity problems was ever really articulated. So we probably need to get that across. I'll definitely agree with Cecilia. We've done it countless times in the past and spoken to customers, and you ask them what they want, and lots of them will describe pretty much what an annuity is. And then when you mention the word, they say, no, absolutely, I don't want that. So there is definitely an issue to overcome as far as the name is concerned.
It's the language thing. I mean, we are pretty bad as an industry, and I'm the first person to push back on the jargon thing. It's not all our fault, because a fair amount of it's been put on us by regulators, but we do slip into a habit of thinking in those terms. For a client, it's, what do you want? Do you want guaranteed income? Do you want flexible income? How important are the death benefits are? And if the answer then is, you don't have to mention the annuity word until you've got to the point of saying, right, this is exactly, this is the income pattern, and these are the options you want in order to deliver this. That happens to be that it's an annuity, or it happens to be that it's drawdown, but we'll use your cumulative savings to give you the outcome that you need.
Thank you all. We've run out of time for today. Really interesting discussion. Thank you. I think basically we are saying that annuities does have a place, guaranteed income does have a place. It's a very personalised journey. It needs to be a holistic decision for customers. Advisors probably do need some help and support with the rise of annuities in these current times, but technology does underpin it. The systems need to integrate with each other, and we probably are going to see innovation in the technology in this space. I hope everyone enjoyed the session, also had some key takeaways like I did. Thank you everyone on the panel for your contributions, really appreciated, really interesting. So thanks very much. And goodbye everyone, thanks for listening.
Thank you all for your time.
Thank you.
Thank you.
Cheers.
Bye-bye.
Thank you.
Bye-bye.